It looks like the Trump trade is back on because of a tax proposal that we're expected to see on Monday, which should lay out the specifications for a corporate tax cut. Trump has been talking about a federal corporate tax cut from 35% to 15% since 2015. JPMorgan's head of equity strategy says as long as headlines continue to indicate political traction, we believe investors are likely to start pricing in higher probability of tax reform. And if you look at the Goldman Sachs basket of stocks that are most likely to benefit from a tax cut, you'll see that they outperformed the broader market right when Trump was elected and then started to correct. But for over the last few weeks, these stocks have started to outperform again on optimism for a tax cut. So how much of a boost could this give stocks? According to JPMorgan, cutting the tax rate from 35% to 25% could increase S&P 500 earnings by $11 per share, bringing it up to $143 per share, which would increase the index 150 points at the current multiple. Jim Febeo, Senior Vice President of Government Relations for Fidelity Investments, points out that before tax reform can advance, Congress needs to pass a budget for 2018 to provide the protected vehicle known as budget reconciliation, which would allow tax reform to pass the Senate with only 51 votes, which means that political pressure to get tax reform could actually help us agree on a budget. But as Fidelity Investments' Jurian Timmer points out, most long-term investors shouldn't react to short-term events. And that's today's bottom line. As a Chicago Booth alum, I consider myself very lucky to have had the opportunity to interview Luigi Zingales of Chicago Booth about his new research, which challenges some of Milton Friedman's assumptions about maximizing shareholder value.